Welcome to the Long-Term Investor. I have a very special guest making a very special milestone in the podcast. I've had lots of repeat guests, but I've never had somebody come back so quickly after their previous interview. Today, I'm joined with Fran Kinniry, Senior Investment Executive at Vanguard, where he is also the head of the Investment Advisory Research Center. And what I like to say is the father of the Advisor Alpha study. Fran, thank you so much for coming back to the show.
Thank you for having me, Peter. I'm glad to be back again.
Well, for those of you who missed Fran's last episode, it was episode 202. We were talking about private investments and how are private markets worth it. And in the email correspondence, I'm told, hey, it's the 25th anniversary of the study that Fran put together, Vanguard's Advisor Alpha. I said, we have to talk about that. So that's why I've invited Fran back today. If you're watching us on Cheddar or on YouTube, you can go to longterminvestor.com. You can see detailed show notes. You can get links to all the resources mentioned. But Fran, let's just start at a very high level. 25 years ago, what was your goal when you first published or even dreamed up the Advisor Alpha framework?
Yeah, so appreciate the kind words there, Peter. Maybe a little context even before the goal. So I had been an RIA. I was at a multifamily office. And so I was an advisor. I was in the shoes that you sit in and a lot of our audience sits in. And so I really believed in the value of advice. And this was pre-Vanguard. I was there for 6 years. I was an RIA, multifamily office. And I joined Vanguard to help Vanguard start advice, our own advice offer. And at the time, I had just the greatest fortune because I had Jack Bogle, who was still here, and Jack Brennan, and they challenged me as we were starting advice because, both Jacks were very, very fee conscious. And they were asking me, so let me get this straight. You're bringing advice to Vanguard. And at the time, we were charging 85 basis points for our advice. And it was largely indexed. It didn't do tactical asset allocation. And so they challenged me to figure out the value. And so big credit to both Jack Bogle and Jack Brennan, because they really challenged me to say, well, why would we be charging our clients a fee on top of a, let's call it a diversified portfolio that's low cost? And where is that value coming from? And so we really put that value proposition together, and a lot of it is outside of investment management. It's all the wealth planning, financial planning, behavioral coaching areas. So that was the original inspiration of the work.
Now, the work itself, I think, also evolved over time as the industry. I think everybody who is in this profession is aware of or has read some of the work that has come out of the Advisor Alpha framework or study. I don't know which to call it because it's not like it was a one and done situation. But basically introduced the concept of Advisors Alpha in 2001. It's in 2014 that you started to quantify it, or at least publish your findings in quantifying it. Can you tell me a little bit about that?
Yeah, that's right. 25 years ago was the inspiration of the work. However, we've been iterating on it all along, right? So we've been iterating on that. So in 2001, it was really just the framework beyond just investments to financial planning, wealth planning. And then in 2014, as you mentioned, we quantified that, which we put numbers to that value. So it went from a conceptual framework to a value-added framework.
Well, and so we're going to go through some of those things eventually where the value add is, but just recognizing how much the industry and the profession has evolved over the last 25 years. One of the things that I liked about the paper that you put out celebrating the 25th anniversary was that you highlighted 3 different things where there were the biggest developments. I mean, I think in general, we should broadly say that a lot of the advisory world has adopted the framework that you put out there when it comes to asset allocation and rebalancing, tax loss harvesting, asset location, behavioral management. But there were 3 things. I'm just going to list them real quickly, and we can dive in at each one at a time. But you note that these things have changed the most. The first is minimizing return leakage. The second is the shift in focus from maximizing pre-tax returns to maximizing after-tax returns. And the third is advisors becoming more proactive as a behavioral coach. So let's start with that first one, the return leakage. What is that and why has it shifted over the years?
Yeah, it's pretty incredible to see. I mean, when we set out, we had hope that this would transform the advisory business. You mentioned, just how many people have read it. It has over 8 million downloads. And so as it relates to action or people actually taking action, I have a couple examples here. Prior to this work being done, and let's call it up until, let's say, 2012, 2013, most cash flow was based on trailing performance. Let's say Morningstar 5-star rating, 4-star rating. And that's how the industry really was when we looked at cash flow. Within the paper, what we saw, though, is around 2012, 2013, a huge shift. And what I mean by that is now 100% of cash flows are based on the lowest cost quartile of funds, both on the equity side and the fixed income side. That means quartile 2, 3, and 4, both on the equity and fixed income side, have had negative cash flow. So that's pretty incredible. What I call investors voting with their feet, advisors voting with their feet to an area that used to be about trailing returns and, let's say, Morningstar ratings, to things that we know are evidence-based, which are cost-related. Just to throw out a number or two for the audience, in 2001, Peter, the asset-weighted expense ratio for equities was 97 basis points. It has come down to 34 basis points. Just an incredible movement of asset-weighted returns, asset-weighted expense ratios. So that's what we would say is removing the leakage of costs. Indexing on the equity side was at 13%. It's now at 58%. So again, I would say the advisor community using an evidence-based process to select their funds. And great to see. The fixed income side, just to give you the numbers, went from 79 basis points to 32. Indexing went from 4 to 39 basis points, 4% to 39% on the indexing side. So just incredible, pretty much transformation of how advisors select funds. The last stat, I know I threw a couple of stats out there. The last stat I would throw out there is, had fee levels remained the same in 2024 that they were in 2001, investors would have paid $144 billion more annually in their fees. So when we talk about reducing leakage in investment costs, we're saving investors, advisors, you all on this call, or listening to this, saving investors over $140 billion a year by using cost as your central tendency to select funds.
It really is unbelievable. And if you want to see the paper, the graphics, the tables are really easy to read, really easy to digest. I'll have a link in the show notes at thelongterminvestor.com where you can see that and go to the page where you download this report. And I started in the profession in 2007, and I feel like, yes, that acceleration, it was questioned during the financial crisis whether this evidence was real. And sometime after the financial crisis, it was a trickle, and then it was an avalanche of people really believing, at least anecdotally from my point of view, and seeing these numbers are so interesting. Looking at the average weighted expense ratio for equity mutual funds being 0.34%. I think if you're watching or listening to us and you're trying to figure out, are my fees expensive? Maybe that's a good starting point. If your portfolio costs more than that, that doesn't have to be a bad thing, but there really ought to be good reasons tied to it, because the more you pay, the less you keep, which I think is something Bogle said. At least it probably came from Vanguard. It's the only place where the more you pay, the less you get. Typically, it's the reverse. Let's shift our focus to the second trend that's mentioned within the paper, which is this focus that went from maximizing pre-tax returns to maximizing after-tax returns.
Yeah, so I think very much like an emphasis on costs, Peter, the better financial advisors have really moved towards financial planning as their value proposition, the wealth planning, if you will. For the most part, we're not working with endowments and foundations. We may have some, but for taxable families, what really matters is the after-tax returns. And so I think what we have seen there is things like indexing versus active. It's just not a cost and performance delta, but there's a huge after-tax advantage in indexing and ETFs. Second, things like asset location, like where you place your assets, making a real big difference. And, when I first started using the word asset location 15, 20 years ago, many advisors had not even heard the term. They were saying, do you mean asset allocation? Now, when we say asset location, it's pretty common that the advisor community knows exactly what we're talking about. But it's not just what is your asset allocation, it's then where do you place those assets between your taxable, tax deferred, and tax-free registrations that really can make a difference.
The third thing I'd mentioned, that the paper mentioned, but I called out, is just, the advisors have become more of a proactive behavioral coach. And I don't want to bury the lead here and steal your thunder, but a lot of that has to do with the idea that when markets are bad, people panic. And when things are looking really good, they get euphoric and greedy, and risk management isn't a term that people are interested in hearing. So I think most of our listeners are going to be familiar with that idea that maybe we're here. You used the phrase behavioral circuit breaker, which I really enjoy. I've always used the term behavioral babysitter, and maybe that's too belittling. I like behavioral circuit breaker. I do hear from a lot of do-it-yourself investors, however, that, hey, I didn't panic in these markets. I don't know that I need any behavioral coaching. So let me challenge. I know you've done other work. Could you give us some anecdotes or narratives around other ways that an advisor will do behavioral coaching other than missing on what we'll call the big mistake during a crash or a rally?
Yeah, it's not surprising to me, Peter, that many clients that you would talk to say, "Oh no, it's not me." It's kind of like how we all hear that we're all better than average drivers, and we're all. I think it's one of the challenges with survey-based research. When asked, it's hard to admit that you panicked and sold out. Let's say this, after Liberation Day when the market was off 5%, 5%, 5%, or in the COVID crisis. So it doesn't surprise me that clients say that. However, when we look at cash flow, back to evidence-based versus survey-based, we do see cash flow following performance. And that creates this drag, if you will. We call it a behavioral drag. And it's part of our advisor's alpha when we get to that 3%. And the drag has shown to be about 1 to 2%. That means that investors trail the markets and the funds that they invest in by 1 to 2%. So we may be talking to a few investors who never panic, but it's also not just the panic moments. There's also the FOMO moments, right? I think a lot of us focus on downside risk like the global financial crisis or COVID or the first couple of days of April. But we easily see it on the other side when markets are really elevated or even sectors. Certain sectors, we see investors chase returns, or I don't know what's going to happen to Bitcoin, but you see, a lot of late entrants into that asset class. So it's not just selling on the, most volatile down days. We see it at the sector level. We see it at the style level. So it's something that's there, even though clients may have a hard time admitting it's them. It's always the other investors. But when we put all investors together and we examine cash flow, we see what is known as a time-weighted return and an dollar-weighted return. And the delta between those has been between 1 and 2%. And that means that all investors, maybe not every investor, but collectively investors have trailed the market by that 1 to 2%.
I'm glad you mentioned that. And I probably could have emphasized the point I'm about to make with the fees, that when you compound that 1% or 2% over multiple decades, it's a big number. And the fees, earlier you mentioned the change in fees, that half a percentage point difference in fees compounds to just be a massive number. But the framework, I've kind of at least danced around what the different aspects are and the value add ranges that you assign to the average client experience. And basically what the study concluded in 2014, and I think sort of reaffirms now in 2025, is that an advisor can add up to and sometimes even exceed 3% in net returns. This isn't really from trying to time the market. This isn't trying to pick which stocks are going to go up or down, or try to guess where interest rates are going, or what's going to happen with the economy or tariffs or the dollar, anything. I'm going to list them off. You have 8 different modules that you describe. You both summarize and you describe in great detail for anyone who's going to download this. Again, the longterminvestor.com. But you have the suitable asset allocation using broadly diversified funds and ETFs. You have investment selection. You have rebalancing, behavioral coaching, asset location, tax efficient retirement strategy, total return versus income investing, and tax loss harvesting. I know we don't have time to dive into all these. So let me, we have not really, we talked about fees, but we haven't really gone into investment selection. And there is actually something in the white paper that I was a bit curious with. It seemed this thing doesn't look like everything else, where you're mentioning education and educating clients about market capitalization and how they can make more deliberate decisions about deviating from market capitalization approach. So let me ask you, is that part of the investment selection thought process? And rather than me kind of referencing something, maybe you can explain it more in full for the audience of what exactly it is that I'm talking about.
Yeah, I would love to go a little bit deeper on there, because I think it is something that maybe a lot of investors and even advisors may not fully comprehend. I would first start off by how does the market capitalization get formed? I'll always hear that maybe the Mag 7 or Mag 8 is overvalued or too concentrated. And not to laugh at that, but the way market cap is, we operate in an auction market, which means that every security trades every day with millions of investors, with price transparency and bid-ask spreads. And what that means is that the capitalization of NVIDIA or Apple or the Mag 7 or the US to Europe is set by active managers. And what that means is if active managers believe that the US should be larger than its 60% weight, they will place more buy orders for the US and it'll push the price up. No different than so what the market cap is globally and locally is the consensus best guess of all buyers and sellers. So that should be the reference point or the starting point of portfolios. Deviating from that is fine, but what we would recommend, or at least make sure investors know, that if you are deviating from the market cap portfolio, you are making an active bet against all other sophisticated investors who have set the market cap and they set it second by second. So it's fine if someone wants to underweight, let's say, growth or the Mag 7 or even the US market, but they should do so with eyes wide open. That they are saying that John Doe or Fran Kinniry, have more knowledge than the collection of all investors put together. And so that's a really tough bogey. So when you think about Vanguard's portfolios, our portfolios are market cap weighted. If you look at our ETF model portfolios, if you look at our target retirement funds, so the case for indexing is not just low cost. Now, I want to be clear. The case for indexing is low cost and they are market cap weighted portfolios. The S&P 500's market cap weighted, the total stock market, the total world, they are all market cap weighted. And so it is a great reference point for investors to think about. And if they want to deviate, which that is totally up to them, they should deviate knowing that they're going against the consensus of all investors, and then potentially right size that bet, because it is an active bet. And they should think about, how different do I want to be from the collective dollars of all assets that are being invested at that point in time. It's been a real hard bogey to beat, Peter. When we look at market cap versus active, tends to be that market cap weighted indexing has outperformed anywhere from 70 to 90% of active managers across all different styles, sectors, asset classes. So It's not just low cost, it's low cost and market cap weighting.
Well, that's a good delineation as you look at some of the tables within this section of investment selection. It is highly focused on low cost. Part of the reason I asked you about the market capitalization is because I saw it called out in a different portion of the paper. And, it's one of the things that I think gets missed a lot in the conversation of active versus passive is it's really less about active versus passive and more about like high cost versus low cost and prediction based versus non-prediction based, or I sometimes say rules based, or transparent versus not, tax efficient if not. Ultimately, the paper finds that the typical added for a value can range between 0 to 100 basis points or 1 percentage point. Obviously, that's variable, but a lot of that evidence is finding a lower cost way to do it. And there are a lot of ways to build an index portfolio. I take a lot of pride in the knowledge of the difference between Russell and S&P 500, S&P and CRSP. And when you compare all the different U.S. large cap indexes, they all perform differently. And understanding the trade-offs is important. Without geeking out too much on one line item, I mentioned I'm not going to go through all these, like rebalancing, asset location, and tax loss harvesting. What I'm going to do is link to more information on those. I was really pleased that tax efficient retirement strategy is in there, something that you quantify as being up to 100 basis points or more of value. And Fran, I just feel like the playbook for accumulating wealth is pretty well known and pretty highly agreed upon, where you try to keep costs low, you try to maximize your tax deferred accounts, and you don't time the market. You just let it ride out. But then when you get to retirement, everybody's situation is different, and there isn't a single one-size-fits-all playbook to that process of getting a tax-efficient retirement strategy. So maybe share some insights here on what your studies found that the value of an advisor was.
Yeah, I agree with everything you said there, Peter. I think in the accumulation mode, there's some pretty simple rules, right? Save as much as you can, save it in the tax-deferred way, have it a low-cost, diversified portfolio. But just think of all the decisions that one needs to make in decumulation or retirement income. Most of these decisions are unknown. This is where I believe even the value of advice could, if you did nothing else other than generate a retirement income stream, you would probably cover your fee because it's extremely complex and it's also counterintuitive. So you don't know how long you're going to live. You don't know necessarily what your expenses may go because there's a lot of wild cards there, such as healthcare costs and others. So you're working with a time horizon that's not known. Your expenses are not known. You kind of know what your assets are. So you have to figure out, what is my spending strategy? There's various strategies you could do. Some do, percent grown by inflation. Some will do an endowment model type where you take 5% of 3-year balance. We developed organically, like 15 years ago, something known as dynamic distribution, which was the first of its time. And we use that here for our own advice. And it really takes into account that the markets are volatile. So you have to have some spending flexibility. The 4% grown by inflation and the endowment model lead you to high spending and run out rates when the markets are high. So we created dynamic distribution. So you have to figure out, what is your spending strategy, your asset allocation, your asset location, and then how are you going to spend those assets in the most prudent way. And then after you're done all that, rebalance the portfolio back to the asset allocation. So there is a lot of moving parts. I know a lot of times investors will say, I have to show transactions or tickets or trades. Any client in distribution generating retirement income is going to generate a lot of trades, even if they're using a handful of index funds, because you're trying to sell, let's say, taxable assets at HIFO lot accounting to minimize taxes, and then you have to rebalance elsewhere, trying to avoid wash sale rules. So it's pretty complex, and the difference between doing this well and doing it average and poor can be extreme. And so it's something that I don't think a lot of the DIY investors would understand to do it well. And so here, again, it's where I think financial planning and wealth planning is going to be the differentiator going forward. Those who really understand best practices, if you will, of financial and wealth planning, I think are going to be set up to deliver value for their clients, that's beyond, as you mentioned, the investment part, right? You can, back to why I developed this, we were using, index funds and not doing tactical, but we still believed we would cover the 85 basis points through areas like retirement income drawdown.
Well, and it's certainly a part of the planning process you can quantify because, as your original work says, you don't attempt to quantify a lot of financial planning work because oxygen is beneficial. Like we know oxygen is beneficial without measuring it, something like that. I know I'm butchering that, but yeah, this was truly one of the parts of the paper where I said, yes, exactly. And look, I mentioned the accumulation doesn't have to be that complicated. A lot of times I find our firm and other firms saying, hey, we help when life gets a little bit more complex. And people think, well, how can withdrawing my money be that complex? And it doesn't have to be if you don't want it to be optimally done. And so really, you guys did a nice job here of quantifying that. One last piece of the module that I want to touch on, even though the value add wasn't material relative to everything else, you basically said it was greater than zero, is a total return versus income investing approach. And part of what was interesting as I was thinking about the past 25 years is in 2001, you probably would have said interest rates were not particularly high, and you might have even said they were low. But for the vast majority of these 25 years relative to history, interest rates have been very low. And this approach became very important. As interest rates tick higher, I think, though, it's not just the return that's higher via total return. It's the diversification. It's the flexibility that makes such a big impact. I had an episode, actually, I'm looking at the episode list. The very next episode after 202 was 203, total return versus income. So I'll link to that. But maybe share your thoughts here on how this found its way into Advisors Alpha in the first place.
Yeah, it's another what I would call somewhat related to behavioral biases or behavioral preferences. A lot of clients do not want to touch their principal. They don't want to touch the corpus or the wealth. And so they try to live off of, if you will, the cash flow that's generated either through dividends or the yield. And the danger then you see is clients, and especially as you mentioned, the last 25 years in a low return world where interest rates were between 0 and 1, I see this affinity why clients then try to potentially buy equities that have higher dividends, right? And or buy bonds that have higher yields. And in doing so, a couple of things happen. One, you've kind of given away some of the properties of diversification, because if you have all high dividend paying stocks and are avoiding low dividend stocks, that would have actually worked out terrible over the last 20 years, right? Because it's been a very growth oriented market. Second is it's very tax inefficient because all of stocks and mutual funds that hold stocks go ex-dividend. So if you have two funds, one with a 4% dividend, the other 2, this one you're getting the 4% on 100,000, but it goes ex-dividend, drops by 4%. This one only drops by 2. So you're accelerating the tax and the worst form of tax. So not only are you giving up diversification, but you're giving up tax efficiency. On the fixed income side, investors weren't happy with the 0 to 1 to 2% rates. So we saw them reaching for yield and credit, maybe high yield. And again, there's nothing wrong with credit bonds or high yield, but we really want to make sure that the portfolio is following a total return, which means get a diversified portfolio, make sure you are comfortable with your exposures. And if you need 5 or 6%, you would then take, let's say you have $1 million, you're going to take $50,000 or $60,000 out of that portfolio instead of trying to make the portfolio yield that amount. By trying to get the portfolio to yield that amount, you are giving up diversification, you're taking on sector risk, credit risk, and you're really giving up tax efficiency. Yet it's something we see happen all the time when we look at portfolios. And I still think it's back to this preference of I don't want to touch my principal, forgetting that all of these assets go ex-dividend.
Yeah, and I mean, sometimes the total return approach is more tax efficient in the grand scheme of things. You get a little more control over it. And we've touched on a couple of the aspects in which your study finds that the value an advisor can add to any given client is up to or maybe even exceeds 3 percentage points. That said, a lot of people still do it on their own. I kind of think of it like mowing the grass. Like, Fran, I'm done mowing the grass. I did it in my 20s. I'm never doing it again. I find value in paying somebody to do that. And the person I used to pay, I feel like it was $35 or $40 a week. It was pretty reasonable. I'm probably too embarrassed to say what I pay right now over recording, but it's a lot higher. But when something goes wrong, like in a storm, a tree fell over a fence and the people were able to fix it as part of my monthly fee. And it was hot as all hell in St. Louis a couple weeks ago. And my grass probably would have died with the other guy, but no, it didn't die with these people. I'm a big believer in that you get value, like you get what you pay for. And even though you've written this study, you obviously feel there's value in hiring an advisor. But to those who are still skeptical, what would you say, hey, like this would be the benefit of working with somebody?
Yeah, I think certainly some investors can do it on their own, Peter. And I would think it would someone probably who has a CFA or a CPA. I mean, the tax part alone of asset location and tax efficient drawdown are pretty complex. And so you probably would want to make sure that you are some kind of expert in tax expertise, CPA, CFP, because I would not underestimate the counterfactual, right? The counterfactual was your lawn is still alive versus it not being alive. I think a lot of investors may think they can do it on their own, but they may not even see these leakages because these leakages are not all that transparent. You didn't know exactly how much you gave up by not having the right asset location, or you didn't necessarily understand how much value you needed to rebalance your portfolio. Did you rebalance the portfolio in the most tax efficient way? So the average client may be doing it as well as an advisor, but odds are just how counterintuitive this is and how much tax knowledge you need to have. I use the analogy all the time of like, I don't think anyone listening to this podcast would go challenge, let's say, an NFL quarterback to a throwing contest. Yet here we are, a DIY investor thinking that we're going to challenge like CFPs and CFAs and estate planning attorneys to handle all of those things. And so I believe the two most important things for most people on the call is your health. You probably outsource your health to the best doctors. And then after that is probably your wealth. And so I would just be careful of maybe not understanding a lot of these leakages you may not even be aware of. They're leaking out of the portfolio, either in behavioral drag or tax drag. And you may be feeling like you're doing fine comparing your portfolio to a 60-40 or the benchmark, but are you doing that after tax? So if you compare your portfolio DIY to the same asset allocation of, let's say, the Vanguard Target Retirement Fund or the Vanguard Life Strategy after tax, and we publish all of our after-tax numbers on our website, and you're really close to that, then maybe you're doing it really, really well and do not need an advisor. But our research shows that most investors are leaking or leaving returns on the table that are far greater than the fee that a professional advisor does, and they can create. But I just want to add one caveat there, Peter. It has to be the advisor doing the right things, meaning what you guys do at Plan Corp, right? You have the planning and financial planning, wealth planning as your base central value proposition. It's not about, I'm going to pick better stocks or pick better funds or know when to tactically adjust. Those things have all shown to be very hard and negative. It's about following the evidence and leading with the professionalization of this industry, which is around wealth planning, financial planning, behavioral coaching.
Well, I'm glad you make that point. Hiring a bad advisor can be more harmful than not having an advisor to begin with. And so that's an excellent call out. And one other thing that I know you agree with, because I've read it in your work, is that this value that an advisor adds isn't necessarily something that's coming all the time. It can be intermittent and it can be intangible, because when you avoid the quote unquote big mistake, who knows how much it would have cost you. But the little savings in taxes, they do compound over time. And eventually, I think the most underrated of things for do-it-yourselfers is just all the science behind cognitive decline. And it's not like you're going to notice all of a sudden. The science says that it starts at age 60 and really accelerates after age 70. And yes, I'm biased. I am an owner at an independent advisory firm. I'm obviously biased, but here I am. Also, I have an advisor myself just because I know that I have too many opinions. So I need a third party just to keep me in check and make sure that everybody else in my family is on the same page. Fran, I know I've taken enough of your time. It is truly an honor to have you 2 times in such a short period of time. I can't wait to have you back again. Maybe we'll give you a little bit longer break this time.
Well, it's a great pleasure to be back again so soon, and I'll take you up on that third chance down the road.
Sounds great. Everybody who's watching, be sure to like, subscribe, leave reviews, and remember, you can find detailed show notes and the resources mentioned during the episode at thelongterminvestor.com. Thanks for listening. Thanks for watching. And until next time, to long-term investing.